Break-even analysis is an accounting technique used to determine a no-profit and no-loss threshold for a business. It uses total and variable fixed costs compared to sales revenue to determine an amount that shows the business has made neither a profit nor loss, also known as the break-even point. The analysis for the break-even point is an important part of a plan for a business that's about to begin operation and an effective tool in determining final product pricing and cost control. In this article, we explain what break-even analysis is, why it's important to a business, and how to calculate it. Key takeaways. Break-even analysis is a process that shows the point at which an investment hasn't produced or lost any money. Lowering costs and raising prices are two methods you can use to lower the break-even point. Businesses often use break-even analysis to determine if it's feasible to add costs. What is break-even analysis? Break-even analysis allows an organization to determine how much product needs to be sold to cover the costs of operating. This is known as the break-even point, and it's the moment wherein the company generates neither profit nor loss. However, it's not a point of stasis, as a business can move into the profit or loss column throughout the year. What break-even analysis does is help the company further break down costs and plan that information into a plan of action. The organization can decide to increase the production of a product or service to generate a profit, or it can stay near the break-even point until it's right to focus on making more money. Creating a break-even analysis consists of making key assumptions based on actual data. They include: Number 1, the total amount of fixed costs remains constant at all levels of output. Number 2, variable costs fluctuate accordingly with the amount of output. Number 3, amounts paid for raw materials, rent or mortgage, wages, marketing, and all other business activities remain static. Number 4, there is no change in the method of production, technology, and efficiency of the labor force creating the final product. Number 5, the sales value of the products is stable and prices are static. How does break-even analysis work? The core function of break-even analysis is to show a business owner the amount of product they need to sell to pay recurring bills and payroll. All costs need to be settled regularly to stay in operation. Owners also earn a paycheck and need to factor that cost into the break-even analysis to determine how much money to pay themselves every pay period. Why perform a break-even analysis? These are some reasons it's helpful to perform a break-even analysis. 1. Determine startup capital. New businesses can use break-even analysis to determine how much capital the new company may require. This can help them create proposals and determine if they need bank loans. 2. Evaluate risks. Established companies may use break-even analysis to better understand the risks associated with different business decisions. When to perform a break-even analysis? These are some situations in which an established company may choose to perform a break-even analysis. Price changes. Businesses can change prices for many reasons. A company may consider lowering their prices to become more competitive within the market or to market their products toward a specific target audience. Before lowering prices, a business can perform a break-even analysis to better determine goals for units sold to justify the price drop. Expansion. Companies can expand by creating new locations, hiring new team members, and introducing new products. Before taking any of these actions, business professionals can better understand if they're a good idea by performing a break-even analysis. For example, a business may determine the number of units sold that can offset a new storefront. Business scenarios. Expansion and price changes are two business scenarios companies may encounter. Others, like recruitment, team member benefits, reorganization, budget changes, and marketing initiatives, can all benefit from break-even analysis. For example, a company may perform a break-even analysis to determine how successful a marketing initiative must be to justify the investment. How to calculate break-even analysis. Calculating a break-even analysis requires examining fixed costs and comparing them against variable and semi-variable costs. These are some steps you can follow to perform a break-even analysis. 1. Gather information. The first step in performing a break-even analysis is gathering information. These are some figures you may need when performing a break-even analysis. Fixed costs, variable costs, unit selling price. How to calculate break-even analysis. Calculating a break-even analysis requires examining fixed costs and comparing them against variable and semi-variable costs. These are some steps you can follow to perform a break-even analysis. 1. Gather information. The first step in performing a break-even analysis is gathering information. These are some figures you may need when performing a break-even analysis. Fixed costs, variable costs, unit selling price. 2. Insert data. After gathering information about fixed costs, variable costs, and unit selling prices, you can plug the data into the formula. For example, Superior Widgets Incorporated has determined that its fixed costs total $5,000 every month. That includes rent, payroll, raw materials, utilities, and advertising budget. The total cost of producing a single widget is $1.25, and each unit sells for $3 for a profit of $1.75 each unit. Fixed costs divided by price minus variable costs equals break-even point in total number of units. $5,000 divided by $3 minus $1.25 equals break-even point in total number of units. 3. Identify the break-even point. The break-even formula relies on using the total overhead costs for the business as the fixed costs. Price and variable costs are input as per unit costs or the price of each unit that was sold. The final step is to identify the break-even point in the number of units sold. According to the analysis, to reach the break-even point, Superior Widgets sets the goal of selling 2,857 units each month. Fixed costs divided by price minus variable costs equals break-even point in total number of units. $5,000 divided by $3 minus $1.25 equals 2,857.